Welcome back, it's JWalter here. I noticed that Fannie Mae actually downgraded their housing market forecast and economic forecast for the US in a new report that was actually just published a couple of days ago. So that's the topic of today's video. I'm going to be sharing all the latest details with you guys and what Fannie Mae has to say regarding our housing market as well as our US economy in the years ahead here. So here's the latest report here from Fannie Mae. This actually was just published on the 19th of April. It says here higher mortgage rates are expected to slow housing activity. Expectations of aggressive monetary policy tightening by the Federal Reserve, of course, through 2023 are likely to further soften economic output already being weighted down by decades-high inflation, which is at 40-year highs, and the ongoing effects stemming from the Russian invasion of Ukraine. This is according to their Economic and Strategic Research Group, or their ESR group. In this report here, they downgraded 2022 and 2023 real GDP growth by 0.2 and 2.4 percentage points respectively. So that's a big decrease in 2023. And by the way, they are predicting a recession in 2023. More on that here in just a little bit. They went on to say the following in this report here. The projected downturn is not expected to resemble the severity or the duration of the Great Recession due to a multitude of factors, including from a housing market perspective, stronger mortgage credit quality. I have some data to share regarding that. A far less leveraged residential real estate and mortgage finance system, and a better equipped mortgage servicer and public policy apparatus, as well as ongoing housing supply constraints relative to demographic demand for housing. Obviously, it's very hard to compare the Great Recession to now because there's so many factors that were at play during the Great Recession that are not at play right now. So for example, ninja loans, where you basically get a loan with no job, no income, and you didn't have to provide any support for your income back in 2008. Obviously, right now, the credit standards are a lot more stringent. So let's talk more about that. So stronger mortgage quality. I actually saw a new report actually just published on the 7th of April. This is according to the Mortgage Bankers Association, or the MBA. They reported that mortgage credit availability decreased in March. And this is according to their Mortgage Credit Availability Index, or their MCAI. So they basically have an index for credit availability for people looking to get a loan this year. So that index fell by 0.7% to 125.1 in March. A decline in this index, by the way, means that lending standards are tightening, meaning it's more challenging to get access to loans, while increases in this index resemble a loosening credit, meaning it's more easy to get a loan to buy a house, for example, or any other type of loan for that matter. So in any case, because this index fell, credit availability is becoming more tight, so it's becoming more challenging to get loans right now. So Joel Kahn, who's one of the MBA's associate vice presidents, had this to say. Overall credit availability was down slightly in March, driven by a reduction in higher loan-to-value and lower credit score programs. So they're seeing fewer programs out there for people who want to buy a house, who have higher loan-to-values and also lower credit scores as well. Here's a key stat here though. So credit availability has gradually trended higher since mid-2021, but remains around 30% tighter than it was in early 2020. That's obviously a positive sign because we want to see people buying houses. We want to see those people actually being qualified to buy houses and not have all the crazy programs we had back in 2008, for example. So I want to show you two graphics to show how credit availability has changed over the years. And then I'm going to be going back to Fannie Mae's forecast here. But I thought it's really important to note this because we're not seeing this extremely loose credit availability that we saw back in 2008. Obviously, right now we have challenges in our housing market, especially with housing affordability. But at least we don't have these really bad loans and banks just lending out loans to people who don't really qualify for it. Anyways, here's their index for credit availability ever since 2011. So as you can see here, the credit availability has increased, meaning that standards were loosening. But back in starting basically in 2020, the credit availability plummeted, right? We're at 125. Back in 2019, we're at 185. So it's becoming more challenging for people to get loans, especially when you compare it to 2017 and 2020. But what's more mind-blowing is have a look at this. Here again is the same index. Right now, again, we're at 125. We saw that dip in 2020. Obviously, the lower the number is, the more challenging it is to get a loan approved. So, but have a look at the credit availability in 2005 to 2007. At the peak in 2006, that index was almost at 900. Now we're at 125.1. So as you can see here, it become more and more loose. Ever since 2020, though, it has become very, very tight to get loans. So the people who are buying houses right now, one would assume that they are qualified to make their payments. So going back to this report from Fannie Mae, they say of course we have a housing supply issue. So here's the latest data we have from Redfin. And this is for the 4 weeks ending April 17th, 2022. So this dark line right here is for 2022. Ignore this bottom line here. These are just percentages. So this is for 2022. So right now we have, well, at least for these 4 weeks period ending in April 17th, we have 496,000 houses available for sale in the US, but that's down 21% compared to 2021. So in 2021, we had approximately 627,000. But look at 2020, we had almost 1 million houses for sale. And then pre-COVID in 2019, we had over 1 million houses for sale. Now we only have 500,000 houses. So we basically have half as many houses available for sale right now compared to pre-COVID this time in 2019. So in other words, we need a lot more houses to be listed for sale in order to cool off this housing market. But I would say that the spiking of mortgage rates will cool down the housing market. But we would have to see, in my personal opinion, see a big increase in housing supply before we see a housing market crash, for example. All right, so going back to the report from Fannie Mae, here's why they're downgrading their economic growth in 2023. So they say we continue to see multiple drivers of economic growth through 2022, but the need to rein in inflation combined with other economic indicators, such as the recent inversion of the Treasury yield curve, led us to meaningfully downgrade our expectations for economic growth in 2023. Again, this is coming from Fannie Mae, just released this a couple days ago. They went on to say data from US economic history suggests that successfully negotiating a soft landing requires monetary tightening to be preemptive rather than responsive. So right now, the Fed is basically responsive or responding to very high inflation numbers, and they're trying to tame those numbers by, of course, raising rates. But that's being more responsive and not preemptive. So it says, as such, we've updated our 2023 forecast to include a modest recession, but one that we do not expect to be similar in magnitude or duration to the recession of 2008. So Doug Duncan, who's a Fannie Mae's chief economist, had this to say: we expect housing to slow. Mortgage rates have ratcheted up dramatically over the past few months, and historically, such large movements in mortgage rates have ended with a housing slowdown. Consequently, we expect home sales, home prices, and mortgage volumes to cool over the next 2 years. In particular, we expect house price growth to decelerate and to be in pace more consistent with income growth and mortgage rates. However, they had this to say: because households with a 3% 30-year fixed rate mortgage are unlikely to give that up in favor of a mortgage closer to 5%, and we expect this so-called lock-in effect to weigh in on home sales. So obviously people have refied into mortgage rates of less than 3%, and they're looking at high home prices right now. And of course, mortgage rates being in the range of 5 to 6% right now. So it would give people very little motivation to sell and to purchase a new property because their housing payments can be going up greatly. So I personally have a 2.6% 30-year fixed rate mortgage. And right now, mortgage rates are about double that. So why would I sell my house and buy a new property when my mortgage payments can be going up greatly just because mortgage rates have been increasing? So they're calling this the so-called lock-in effect. And I want to give you guys an example regarding this because, as you guys know, mortgage rates have been increasing greatly. Let me just show you the latest stats we have actually regarding that. So right now, as of today, which is the 22nd. I believe this is actually for the 21st right now. They haven't updated numbers as at the time of this video. Anyways, the 30-year fixed rate mortgage, according to the Mortgage News Daily, is at 5.38%. Compared to 1 week ago, that's an increase of 23 basis points. Compared to 1 month ago, 72 basis points. To give you guys an idea about how crazy it is, because back in 2018, it took approximately 11 months for mortgage rates to increase in the range of 4% to 5%. Now we're seeing mortgage rates increase 72 basis points in 1 month. Absolutely insane. Compared to 1 year ago, we have increase by 2.22 percentage points. A huge increase in mortgage rates, something we haven't seen in decades, frankly, so it's pretty remarkable. By the way, too, this year, the best rates you can get only for people who have exceptional credit, of course. And also these rates also include, at least for the 30-year fixed rate mortgage, include paying points of 0.4 points. Another source is Investopedia, someone who had commented on my channel regarding this. So Investopedia is stating that the average 30-year fixed rate mortgage right now is actually at 5.6%. FHA is at 5.67%. Obviously, mortgage rates can differ. These are the averages according to Investopedia and the Mortgage News Daily for people with exceptional credit, of course. In any case, I want to give you guys an example regarding how high your housing payment is compared to now compared to 1 year ago. So let's just say someone's buying a house for $500,000. They're putting 20% down. That gives you a loan balance of $400,000. So let's say they buy a house basically 1 year ago. Rates approximately 1 year ago were around 3%. So let's exclude any home insurance, taxes, and HOA. Your payment 1 year ago for a $500,000 house would be $1,686 per month for principal and interest only payment, right? Fast forward to now, again, same price point, $500,000, 20% down, $400,000 loan. At current rates, at 5.38%, again, this is approximate rates. Everyone's gonna get a different rate based on their own circumstances. But let's just go with the Mortgage News Daily's average right now at 5.38%. Again, no insurance, nothing else, just principal interest payments. Your new payment would be $2,241 per month versus $1,686 per month given rates 1 year ago. So in other words, buying the same priced house now compared to 1 year ago, that's going to cost you $555 more per month to basically buy the same house 1 year ago. However, home prices have increased, right? So home prices have increased around 15% compared to 1 year ago. So that $500,000 house from 1 year ago, you can't buy that same house today in most markets because home prices have increased around 15%. In any case, I agree with what Fannie Mae is saying here. They're saying that there's gonna be a less motivation for people who have less than 3% mortgage rates to buy at current rates right now. And as we can see there, an increase of about $555 per month for buying basically a $500,000 house. However, Fannie Mae had this to say: if mortgage rates remain relatively elevated, we expect the added affordability constraint to price out some would-be first-time home buyers, and that would contribute to the slowing of housing demand. And speaking of housing affordability, if mortgage rates continue to increase and we don't see a decrease in home prices, of course, housing affordability is going to get worse and worse and worse. So the Fed, by the way, is going to be meeting in about a week. So 1 week and 5 days to be exact at the time of this video, according to investing.com. But they are forecasting to increase the federal funds rate 50 basis points. So right now, the street is forecasting the Fed to increase the federal funds rate by 50 basis points. So again, the Fed does not control mortgage rates, but when they do increase the federal funds rate, which is a short-term borrowing rate that banks charge each other to lend each other money, that can have an impact on mortgage rates. So if the Fed increases the federal funds rate by 50 basis points, mortgage rates could potentially increase. And meanwhile, right now, the yield on the 10-year US Treasury note as of the time of this video, which is the 22nd, is approaching 3%, a big increase compared to 1 year ago when the rate was approximately 1.6%. So comment below with your biggest takeaways from today's video. Also, if you got any value out of today's video, then please hit the like button. I greatly appreciate that. Hope you have an awesome day. Look forward to seeing you on the next video.